You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 3 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuikStrike, options pricing and analysis software. QuikStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuikStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuikStrike is the perfect addition to your trading toolkit. Learn more about QuikStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuikStrike1. That's QuikStrike1. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funky tune means it's time once again for TWIFO. This Week in Futures Options, the program here on the old Options Insider Radio Network, where we break down the hot products, the interesting activity, sometimes the weird and unusual activity that's lighting it up on the other side of the fence, usually the commodity side of the fence, so your crude, your gold, maybe even your financial futures and options out there too, and who knows, maybe some live hogs will make it into the mix this week. You never know. It's a crazy time over here in all things futures options. My name is Mark Longo from theoptionsinsider.com. As well as, of course, from the ever-exciting Options Insider Radio Network. 15 programs for you guys to choose from, including many great archive episodes of this fine program, TWIFO. So if you're just joining us for the first time here in 2017, first, welcome. And secondly, you got a lot of great archives to sink your teeth into. The easiest place to do that, theoptionsinsider.com. As well as, of course, over there on CME Group, they have it up there as well. As well as, of course, all your favorite iTunes and Stitcher or TuneIn, all your favorite podcast stores, Pocket Cast, etc., and so on and so forth. If that's all too much for you, just grab our mobile app available for iOS and Android and the beloved Fire OS, and then you can get access to our whole, yes, a decade's worth of content now. This January marks the 10th anniversary of the Options Insider Radio Network. Kind of hard to say that with a straight face, but so a lot of great content waiting for you. Just grab that app. And however you listen, including those of you who can join us live every Friday, 1:30 p.m. Central via Mixlr. Welcome to you guys over there as well. We love you guys. However you join us live after the fact, streaming, downloading, etc., make sure you hit us up with those questions, those comments. We love to hear from you guys. And joining me on the old program today, starting off, is my typical futures options compatriot / partner in crime, Mr. Nick Howard, the creator of a little platform I like to use around here called QuikStrike. Nick, welcome back to the TWIFO program, sir.
Hey, guys. Good to be back. Looking forward to having a chat again this week. I got some interesting stuff I think there is out there, so let's get going.
Yeah, well, let's do it. Before we get going, let me also introduce my in-studio cohort sitting in the CME hot seat this week. He is an old friend of the network, but a first-timer on this program, Mr. Dan Cook, the VP, nay, the major domo of all things business development over there at Nadex. Dan, welcome to the TWIFO program.
Thank you very much, Mark. It is great to be back. And by the way, happy anniversary.
Yeah, crazy. Hard to fathom. 10 years.
It is hard to believe. Just 10 years flies right by.
We had this crazy idea pre-iPhone. Let's try an options podcast. Nobody's doing that. And a decade later, look where we are. So crazy times. Before we get started, real quick, Dan, at the top of the show here, why don't you give our listeners who may not be familiar a little bit of an overview of what the heck Nadex is and what you guys do?
Nadex is a little bit unique. We're exchange designed for the individual trader. All of our contracts are limited risk. We're a derivative. For example, a lot of our contracts are based on the CME underlying markets, things such as crude oil or the ES contract. And what we offer is really a limited risk option style type of trading based on those popular contracts, really designed for the individual.
There you go, listeners. You can check it out for yourself, nadex.com, to learn more. And it actually feeds in well to what we're going to be talking about on the show today, because a lot of those binaries that we see going up on Nadex are, I'm sure you'll agree with this, Dan, in many ways complementary to a lot of the action we see in the big, let's say, WTI options and futures. A lot of people who trade those will then turn to the binary maybe for a kicker or maybe for some sort of hedge to the extreme movements that we're seeing in some of the commodities. Would you agree with that?
Absolutely. They make a very complementary type contract, both binary options as well as our spread contracts. We do have quite a few members that are trading the various CME contracts, gold or oil, or basically you just name it. We offer a very similar type contract, but they can use them either as a kicker or in conjunction with the strategy that they're running in the underlying market. So it makes a very complementary type of contract.
That's pretty much the primary use case I see from a lot of people who trade, the mothership WTI and others is, the binary is a great way to be the hedge with a strangle, let's say, in case the worst comes to pass. And maybe you don't want to do that with a full priced option, or maybe you're not worried about the entire week or month. You just have one particular report for a few minutes on one day that you're worried about, in which case a very limited time product like the binaries makes a lot of sense.
Yeah, absolutely. Particularly, you look at a Wednesday morning. If you've got a position in the underlying market in oil, you may not want to unwind that, depending on the size, all the different parameters you might have. You might want to look to a different contract where you can take advantage either to protect yourself or take advantage of a short-term speculative play.
That's why we wanted to have Dan on today. He can provide a little bit of extra color on some of the color we're already going to give you on the big products. He can say what's going on out there in some of these other products that are very much related to what we're talking about today. Let's kick it off, Nick, in an area that's been near and dear to us and to a lot of our listeners of late. It's kind of been an interesting one to watch evolve. Certainly when we started this show last year, Nick, I don't think you and this product, I don't think even it didn't exist to the degree it does now, let alone the fact that it'd be so tumultuous. Of course, none of us could have predicted we'd have maybe the regime change we'd have in Washington as well. So that also threw this product into a little bit of a tizzy. I'm talking, of course, about the WTI Brent spread. This thing has traded in a relative range despite a few maybe structural issues in the market. Obviously, a lot of it driven by the logistical differences and tax differences between what's produced domestically here, of course, the West Texas Intermediate, and of course, the Brent, which is primarily international. And of course, we're seeing a lot of flux, shall we say, on the international taxation front, hence a lot of the trading we've seen lighting up this product of late. And Nick, I know you've really become a convert to this product of late. You've been digging into a lot of what's going on in WTI Brent. We've outlined and highlighted on this program the last couple of weeks. I encourage listeners, if you're tuning in for the first time, go check those out if you're interested in WTI Brent, because we highlighted a lot of very, shall we say, well-timed activity out here in some of this product, and some of it a little bit not as well. So it's been kind of interesting. But that said, Nick, I know you've been really keeping an eye on this. What's catching your eye out there in WTI Brent spread land this week and its ongoing battle with the new administration?
Well, I'll reiterate a little bit about what we've talked about previous weeks, just for anybody who's tuning in today for the first time. So every time there's an increase in open interest going forward in this contract, until at least it looks like for the next 2 years, we're going to be hitting a new open interest record, because this is the first time we've been up over 123,000. We're currently at about 143,000 in almost 2 or 2.5 years. So any openings are going to continue to push this OI higher and probably draw more attention to the trade itself. So as you recall, at the end of last week, we got some news that potentially that we had an idea a few weeks back where there was a possible tax on imports of oil, which would have caused the Brent to be more expensive in relation to the WTI, which started to push that spread a little bit more close to zero, meaning Brent was more expensive than WTI. Now WTI was catching up to the Brent, and consequently, what we saw a few weeks back, or maybe even at this point, I think it was it was December, it was mid-December, maybe is what it was. The time has flown. This January is gone already. So it was back in December, I believe, where we started to see contracts that were positive strike contracts that really traded for a significant size, and we were seeing these trades way out on the term structure. And the first ones we saw were in the December 2018 contract, and then we started to see them in the June 2018 contract, and then they started to trickle forward in the term structure. But that has been, we went from basically having almost no open interest in this product to, or from very small open interest to doubling the open interest just on that December 2018 contract. So what we saw were strikes that were trading a zero strike, which meant WTI was the same price as Brent, and then we saw plus half, plus one, plus one half, plus two, plus, all the way up. I think even 2.5s might have traded, maybe just twos. But we saw where WTI, by that time, people were expecting WTI to be more expensive than the Brent. And a lot of this was driven by that possible incoming tax on the product itself. Now, at the end of last week, we saw that rhetoric had been kind of shot down a little bit. So you saw that spread widen again. But and getting into this week now, what we saw is that stabilized to got a little bit tighter, a little bit more toward zero again. So we're trading around, I think it's just under -1. But we saw again this week more openings in strikes, and we saw openings in a little bit closer to expiration, to our current date than we have in the past. So we saw a few openings in the June 2017. We saw some and that's in the zero strike. We saw some openings in the December 17 contract, small, but trading at 1.5 strike, meaning WTI's $1.5 over the Brent. And then for the big one, we saw a little bit more in the June 2018, but we saw another new position of 1,000 contracts in the parity strike, the 0.00 strike out in the December 2018. So, we saw that trade zero up to the $2 strike, now back around the zero. That's where the at the money is right now. So there are people taking new positions out there and still believing that we have a chance to make that cross over again, where WTI is a little bit more expensive than Brent. So again, if nothing else, we just sort of another product to watch, and to watch the open interest and to listen to the news, and maybe not necessarily have to pay attention so much, but looking for any kind of tidbit that might spark a little bit more activity in that product itself.
Yeah, speaking of the product, let's get into the mothership WTI, the mothership Crude now as well. And even before we do that, Dan, since you're sitting there so smugly in the CME hot seat, I can see. It's nice to have you in studio here to see your face. It makes it much more fun. But yeah, since you're sitting there over there in the CME hot seat, before we even get into the what's going on out here in the regular WTI, give us some color what you're seeing out there in the binaries, because in a lot of ways that's informative and reflective of what we're seeing in the big mothership product. So what's been lighting it up out there in Crude over there in Nadex this week?
Certainly. Well, first of all, thank you for saying looking at my face is fun. I think that's the first time I've ever had anyone say that. I'm not exactly sure which way to take it, but I'll take it as a positive.
We aim to make our guests uncomfortable here on the program. So.
Absolutely. What we're seeing in really binary options is where we get a lot of traction on this. And so maybe just a brief introduction on those. They're really the price is a probability. So you're looking at a strike price, just like in an option, and what is the probability of, in this case, oil to be greater than that strike price? They often call them predictive markets because it might be people's expectation of what's going to happen in the underlying market. They can be traded directionally or direction neutral in such a thing as like a strangle. And that's really what I've been seeing, particularly this week, as we've kind of been in a bit of a range. From the activity I'm seeing, it suggests that people are thinking we're going to break out at some point. They're not seeming to trade it as much directionally, but they're just taking that range. They're doing effectively what's similar to buying a call, but it's a cheap call. Again, we'll see with volatility, which is remarkably low from what we're seeing on our side, that could just light up at any time. And they want to be prepared for that. So, as an example, if oil's just trading, say, at 53.5, they might be buying a 54.5 call that's only a 10% probability of happening, meaning they're buying it around a 10 with a potential upside of $90. And that's just $10 to $90. On the other side, maybe it's a 52.50, depending on the time frame that they're selling, at a 90 or a 95. What that means is they put up basically $5 or $10, depending on the price level, with the upside of 90 or 95. And we're seeing them actually take both sides of that trade, which suggests they're looking for something that has a low risk profile with a high potential return. They're looking at it to definitely break out of the channel rather than stay in there. Now, one thing with volatility, the higher the volatility in a binary option, the closer to 50 it puts. So people are still able to get into these really inexpensive contracts with a high potential upside, just hoping one side gets filled and it takes a run.
And so it sounds like people are for the most part, they're specking on a breakout. Obviously, with binaries, you're not talking specking on a move to like the 100 strike. They're very near-term contracts. So probably more, you said 54.5. Is that about the strike range? You're looking at 55, somewhere in that range? Or is it more exotic, 60, 75, something like that?
Because of the short-term nature, yeah, we're definitely not looking at 100. Depending if, particularly when we start next week, when we come out on Monday, we'll have a week-long contract. There we might see people going out to the 60, 65s, or down to, the 45s, 40s. But for the most part, in the short term, we're looking more at, does it move $1? Does it move $2 on this day? Because with the binary, you don't have to, it doesn't matter how far the market goes above or below the strike. It only has to do it by, a tenth of a tick in order for it to settle in your favor. Or, of course, if you miss it by that tenth of a tick, it's out of your favor. But so it's really more the short-term move that they're looking for one of these days. And judging by the activity, not in the distant future, that they're looking for it to break out of that. And then, of course, because we continue to roll contracts, they can roll into the next one, whatever their bias is.
That's interesting. Let's see if that's backed up by what we see here on the big mothership WTI. And actually, Dan, is kind of interesting because we're looking at it here right now. And again, listeners, if you want to follow along, cmegroup.com/Twio. And you could follow along live in the chat room or after the fact if you're listening on demand to the podcast as well. You can always get access to all that material completely free, which is kind of nice. You can see the exact same report that Nick, Dan, and I are looking at right now. And you'll see, ironically, because you're talking about calls there in the near term, Dan, actually number one with a bullet this week was the front month, so the March 50 puts out there in WTI, which is kind of interesting. So maybe playing both extremes. Maybe playing the binaries on the calls, maybe playing the WTI on the puts. About 20,000 and change going up out there in these 50 puts, with the lion's share coming on Thursday and today. Pretty aggressive days. Size opening yesterday on that activity as well. So 50 puts lighting it up, but not far behind. You weren't. It wasn't completely a different story here, Dan, because number two, very close, about 18,500 was the 55 calls, which sounds like that's pretty much in line with exactly what you were seeing out there as well. Very near-term call activity. This has kind of been the range we've seen Crude kind of training around for a while. 50 puts, very active. 55 calls, very active. People poising for it to break out of that range somewhere in both sides. About 18,500, like we said, going up. The lion's share again today, about 6,700 and change going up today, including a good chunk yesterday, opening as well out there on Thursday. So opening positions in both of those, then followed by the 52 puts. So perhaps a little bit more, a little bit tighter put there as well. About nearly 17,000 of those going up, pretty much spread evenly throughout the week with the exception of today. Not a lot lighting it up out there today. If we look also back to what's been going on the future side, a relatively net close to close, not the most action-packed of week, off about a half a handle or a point depending on where you're looking out there in the big WTI futures term structure. The vol also continues to erode. This is something we've been talking about for a while, Nick. This vol out here in WTI can't seem to spark to life. It seems like, and maybe this is reflected by the option paper and the binaries as well, maybe we need another event. We need another, on our last program, someone only half jokingly referred to it as the OPEC Thanksgiving volatility massacre, because that event happened, the WTI took off, and volatility got crushed, and it hasn't really looked back. And maybe we need another event of that seismic nature out there in WTI to really shake us loose of either the underlying range or the volatility range, or maybe both. Overall, volume-wise, was a pretty good week. Open interest up about 5.5% out there in the WTI as well. And Nick, I'll toss it over to you now because I know you're the major domo of all things QuikSkew. What are we seeing out there in QuikSkew land, as well as your thoughts on the paper this week and the volatility out there in WTI?
Well, first, I'm going to go back. I looked last week at the WTI This Week in Options report, and we saw overall in the contracts that we are typically talking about, which is the 2017 contracts, and then we always add the June and the December contracts of 2018 in there, where the majority of the open interest is and where the majority of the trade takes place. So, and this is more in response to what Dan had to say. So last week we were at a put call ratio of about 1.25, okay, across the board. So there was about 25% more put volume than there was call volume. Now this week we're seeing that ratio across the board is more toward 1, or even a little bit biased towards the calls. So it's let's just call it 1. So we're definitely seeing a shift more of sort of that balanced nature, right? That we were talking about, that there's people are expecting something, but they don't know what to expect, right? That's typically a strangle play. That kind of 50 delta coin toss that you get with the binary option makes complete sense if that's the sentiment as well. And really, when you start to look at the overall the put call ratio across the whole spectrum of trade this week was definitely pretty flat. We had some puts more in the short term from a March contract, but when you start to go out on the curve, you're definitely seeing where the calls were dominating a little bit more. So I think that, as you stated, Mark, I'll get to the QuikSkew, but we're again in this trading range, right? And we said last week, if we thought we were going to be in that trading range, we would have expected vol to come in a little bit. You're seeing vol come in even in the front contract, which is telling you that it's not catching up with the decay, right? So usually you see that front contract tries to get pumped up in vol because it's getting the decay is getting knocked out of it, but there's even some lack of interest there. But again, like you said, still increased OI, and which is a positive overall for the contract itself. And as far as the skew goes, we're seeing generally in the front contracts, as we're starting to see, we're seeing a little bit more of a push towards balancing. So the volatility came in 1 point meaning that the calls got a little bit better in relationship to the puts, but we're also seeing that same positivity in the April and the May all the way throughout the rest of the year. So I would tend to agree, since we've been in a range for such a long time, the 50 to 55, and if you go out there and look and start to take a look at what the open interest looks like in each of the contracts, you're seeing it's fairly well balanced in terms of the put call ratio as well. So I think people don't know what the event is, but they're looking for an event, and that's why they like trading the binaries, and that's why I think you're starting to see sort of this balanced trade in the put calls, both from a volume and from an open interest standpoint.
Yeah, and moving on, another product that's been kind of lighting it up, another one of our hot products, a regular offender, repeat offender here on the old TWIFO program. It is, of course, the shiny stuff, gold. It's been an interesting week to watch that as well. After a relatively quiet week the week before, this week the future's off. Depending on where you're looking, about 15 to 20 handles out there on the old term structure. So again, not the best week again for all the gold bugs out there who are hoping that sell-off had ended and we were back in rally ho mode. We mentioned last year, and again this year on the show as well, that gold's been a very interesting product from a volatility skew perspective. People post-Brexit, post-election, just a random Tuesday, people are piling into calls, they're piling into puts. It has the most, I think, evolution and fluidity of any of the products we talk about here on the show in terms of the volatility skew. But before we even kick off the big gold, Dan, I know you guys have had a lot of interesting activity out there in the Nadex gold contracts as well. Give us a little bit of color, what you're seeing out there in Nadex land, and then we'll kind of accrete it back into the big products here.
Certainly. Well, almost the opposite of what we're seeing in oil, where people are looking at that range. By and large, the gold play had seemed to be much more directional. And again, I only see one side of the trade. Nadex is a separate exchange, so it could be protection from their underlying CME positions. That is always one possibility. So again, I only see half that trade. But it was definitely biased more towards what would resemble put activity throughout the week. It was fairly overwhelmingly put activity from our direct member perspective, almost indicating that they think where we had those events previously, that we're kind of going to rebalance, we're going to continue maybe that slide. Some interesting activity today, but again, it could be closing off some positions and different things heading into the weekend. It'll be interesting to see on Monday if we start to see those gold bugs come back in and
they're
push
always
it
so
higher.
reliable, aren't they? They're kind of like the Apple traders back in the day, but they seem like they might reduce in number a little bit, but they never really go away. The gold bugs are kind of this omnipresent source. I mean, it must be great for you guys and for the call traders out here because they're gobbling up these calls all the time. But it's kind of a nice renewable source of value.
Yeah, looking at just some different levels and not just from Nadex activity, just from myself. That are we going to break below that like 1175? It seems like we've got some puts lined up there in the underlying market. Are we going to break lower from that, or is that going to be kind of that line in the sand where the gold bugs say, you know what, that's enough. Let's start pushing this up a little bit higher and see if they get any traction on that one.
Yeah, it is interesting to watch because you're right. I think that pronounced sell-off we saw towards the end of 2016 really, I think, broke the spirit of a lot of the gold bugs out there. They were kind of like, when we for a long time on this show, we like to talk about risk reversals out there from a volatility standpoint and a skew standpoint. And we were talking about the 1,200, 1,300 in the big, COMEX gold contract for a long time. And then we kind of broke through that 1,200. We haven't even looked back for some time. Now we're kind of floating around it again. But yeah, it seems like this just kind of it may have taken some of the steam out of those gold bugs out there. But it has been another active week. Again, you guys can follow along with the charts yourselves for free over there at cmegroup.com/TWIO, TWIO. Leave off the last F there for futures, and you'll get it there, no problem. And what we saw out here was another active week out here, up about 5% open interest over there in the big gold contracts. Even though, like I said, the futures selling off a wee bit out there. Not the best week for the gold bugs out there. But if you're asking what was lighting it up, perhaps not surprising, and maybe this kind of dovetails a little bit what you were saying there too as well, Dan. Not surprising that it was puts leading the dance this week, given the fact that it was a broad sell-off in the futures. In particular, it was the March 1175 put, so a very reasonable strike, all things considered. It wasn't like it was 1100 or 9.5 or something like that. It was a very reasonable strike to the tune of about 6,300 contracts going up, about half of that going up yesterday on Thursday. So with a good chunk of that opening throughout the week, followed number two with it was a little bit farther out for the number two contract. It was the April 1180 calls. So there are some gold bugs still out there, Dan and Nick. They're lurking. They're a little bit maybe hard to find, but they're out there these days. A little bit less volume for them, about 3,100 and change, just about in line with the number three contract out here, which was indeed the front month again, the March 1225 calls. So a little bit more optimistic there on that front, with also about 31, nearly 3,200 going on out there. The lion's share of that, about half going up on Thursday. So kind of an interesting demarcation out there between the overall options volume. From a vol perspective, it has been kind of interesting to watch, Nick, because gold has been volatile. It has been moving around, yet the vol, at least of late, can't really seem to catch a break. Doesn't matter where you're looking. If you're looking at the implied out here in the big gold, some of the other measures out there, it really is came off again this week, about a point, depending on where you're looking on the term structure there, but roughly about a point again this week, and didn't have a lot of room to drop already. So that's kind of interesting in and of itself, Nick, that this vol, these premium buyers out here, they can't catch a break, or maybe conversely, this is attractive for you. If you're interested in gold right now, you want to come in and dive in. Obviously, you have to be cognizant of skew. We'll get to that in a minute with Nick and his QuikSkew. But overall, net at the money vol creeping off again this week. So maybe for premium buyers, this is a time to be interested, or does your QuikSkew dispute that, Mr. Nick?
Well, I just want to get some verification from Dan real quick. So what is gold saying again? They're saying it's a bearish play right now. So that means it's trading at can you explain where the premium would be on the gold right now, Dan, just from that standpoint?
From that standpoint, and again, I just want to reiterate because I only see one side of that trade. So somebody could be if somebody's really bullish, actually bullish in gold, they might be looking, or if they're looking to get bullish even, they might be getting a little downside protection on ours. So from my side, it may look like it's more put activity. It's hard to get an overall underlying market bias, and the underlying market's really is going to be what drives ours. But yeah, just what I'm seeing, my limited view, it would seem to be more of a bearish outlook at this point. But it doesn't seem to be overly. It seems to be like they're not too far off the market. So, it's almost one of those levels where I think 1175, 1170 in that range is going to be pretty interesting to see if the market decides that's low enough. And that's why I think it'll be interesting on Monday if I start seeing completely the opposite activity. if I see the speculators start coming in and all of a sudden looking to get a little bit long. And again, that's one of those things, unfortunately, I won't know until Monday.
Sure. Okay. Well, that's just wanted to clarify there because, again, the 1175. I'm sure you're referencing the CME open interest, but that's the big strike in terms of the open interest, and a lot of that additional sort of support came in there this week. So that contract opened up with 2,200 in open interest. So that really caught what was previously the 1125, which was the higher open interest put from this week. So. We've been talking about gold off and on for quite a bit, and it really is. And I have the 30-day rolling volatility in front of me for the last 2 years that I'm looking at, and we are approaching the lows in the last 2 year period. We hit a more significant low back in 2013 than we have seen in the past back in early 2015 or mid 2015. But I just. We've talked about it quite a bit. We were at the bottom end of a range, right? And we talked about volatility being low at that time. And we were saying, buy puts and buy futures because you can get in at what looks like to be a bottom from both a price and from a volatility standpoint. So not only do you get the benefit of the rally, if you think that's the way it's going to go, opposite to what the Nadex might be saying, I always, if you think you're getting to a bottom of range, like right now we're at 1192, but if you think we approach that 1175, and volatility continues to get decimated, that's when that's when it would probably turn over on the Nadex side. But on the CME side, more than likely your puts are going to be as cheap as they were, and your futures are going to be as cheap as they've gotten, and maybe holding a support there. And it might be a good time. And again, I tend to like that trade. I tend to like hedge trades that take advantage of ranges that seem to be exhausted and volatility that seems to be way too low. So. We saw 18 plus vol in early November in this 30-day contract, and we're already down to 11 3/4. So, there's some room to move there, especially if we get some sort of surprise. So the trade itself has been pretty even in the front contract. About the volume this week was 1.0, so calls and puts traded pretty evenly. And then as you go out on the curve, you got a little bit more call bias, and then you go out further, you get a little bit more put bias. But overall, the open interest is telling us that people have more calls out there than puts. But and that just could be the trade selling into that rally and stuff like that. So we'll have to pay attention and see what's going on there. But from a vol standpoint, continues to get beat up pretty good, a full point almost across the entire term structure. And then the skew, right? So we talk about the skew in a couple ways. We talk about it as an absolute in terms of the volatility difference between the call and the put. And right now the call is a little bit cheaper than the put in the front contract, but overall they seem to be pretty even. And we also talk about the QuikSkew, and the QuikSkew is just a way to take a more measured approach against the skew and say, well, how do my call and put look in relationship to the at the money? And right now what we're seeing is, I'm pulling up my chart. We see that the call is pretty much, the 25 delta call was pretty much even in terms of its volatility measure with the at, and the put is just a little bit over. So again, I just reading the skew and looking at the volatility, we have a pretty balanced vol smile here, which tends to make me think that we can go in either direction, and we have a low volatility. So to me, looking at this kind of stuff, if you have the opportunity to get, and especially if you're looking, in this case, you could probably make a pretty even directional play where you can get in there and get some cheap 25 delta strangles and really get in for a low volatility play or a directional play, and you're really pressed very tightly against at the money. So if you were to get a pop, you can then sell the straddle and really take advantage of that spread, because the odds are if we get a pop, you're going to get the wings bid up, and the straddle's aren't going to catch the wings. So this is I think gold is something to really pay attention to right now, just based purely on the numbers, because we've seen this skew rock around quite a bit, and right now it's about as flat as it's been in a long time. I'm looking at the March contract, and it hasn't been this close to a flat 25 delta to 25 delta in a very long time. And if I go out here and look at the 30-day constant maturity QuikSkew, give me 1 second and I'll pull that up. Let's see what we got here. And this thing, same thing. We're looking at probably as tight as it's been in a long time. So gold's probably, I mean, you got WTI, right? And then you got the black gold and you have the regular gold. It looks like that trade's going to be, there's going to be some opportunity there just based on the fact that volatility is so low. We've been trading in a range for such a long time. We have such a balanced vol curve. There should be plenty to do out there.
Yeah, it has been a fun one to watch, and I think we'll be talking gold again on the show in the near future. Just a wild guess. Between gold and WTI, they have been taking up a lot of the oxygen in the room. In fact, some of our listeners are writing to us about that just now. So let's get to your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody. Like the man said, this is the portion of the show where you guys get to take the reins with your questions, your comments, your insights, not just for us, but for your fellow TWIFO listeners. Going to kick things off with Sellopod. I like that handle on Twitter. Probably sounds like he's one of our many listeners from the floor of the CME. The SR people still down there, listeners, and they're doing a lot of action, particularly in the options pit. And Sellopod wants to know, easier for me to say, Sellopod wants to know, why don't you promote or discuss the liquidity and cost effectiveness for the end user of the big S&P option pit? I'm just going to go out on a limb and guess he's standing maybe out in the big S&P option pit. But that said, it's a good point, Sellopod. At this program, we get pulled a lot into the commodity weeds because that's just where so much of the interest in the action is. We talked about gold and WTI again today. And quite frankly, for a lot of the other products that are more S&P and index sensitive, we focus on those on a lot of the other 15 programs on this network. So we tend not to spend a lot of time on this particular program getting into the specifics of what's going on out there in the big S&P options product. But that said, Nick, maybe that's an oversight on our part. Maybe we should do a little more straightforward indice type stuff, just because obviously there is action in those. And as you mentioned, the big S&P option pit over there at CME Group is still lighting it up. So I don't know, what are your thoughts? Are we remiss here? Are we not doing our due diligence by hitting on the indices? I just figure our listeners get so much of that already during the week. They want to hear, the more esoteric commodity stuff on this program. What do you think?
Well, I think it's probably a little bit of both. I think part of it is that we've been sort of lured away from the S&P because we tend to see that there's not much change in the way the skew is or anything like that, or at least there hasn't been until maybe recently. So there's not always an interesting talk about, the risk reversals changing valuation very much and those kind of things. But yeah, we definitely, it's something that we can do to focus going forward. Now, I will say with all that being said, right, because I think that's usually been our, the skew we always say, the skew doesn't change all that much in the S&P. So what's the point of really paying attention to it? But if you look at the big S&P, well, first of all, let's point out about the big S&P. There's about 600,000 contracts at open interest in the options out there. And there was an increase of 100,000 this week, Bobby. So it's about a 20% increase. And the ratio of trade across the board was about, with puts taking like almost 50% more than the calls. So there was a lot of activity out there. But ironically, we're seeing that the skew itself, if you're taking a look, Mark, and everybody can go out there and look on cmegroup.com/TWIO for the TWIO report, we saw that the calls caught up, or there was a much more positive skew. So we're almost flat. Well, today, this Friday expiration doesn't really count. next Wednesday has gotten a lot more positive. Even 5 days out more positive, 7 days out more positive, 14 days more positive. So that's quite interesting when you think about it, because we've generally said, there's not much going on there, but it certainly looks like we're seeing a vol curve that we haven't necessarily seen out there in a long time. And what I'm going to do is I'm going to take a look at the skew and see what's going on. And we're definitely getting more positive. And what I want to also do is I want to take a look at the QuikSkew on this, and we're going to see what it says here for us. Let's see what we have that we want to look at. Are we taking care of this? Let's do this one and see what we got. Apologize for the quiet air there. So let me look at this 3-month.
Yeah, but listeners, you can, while Nick is doing that, you can also follow on, like I said, acmegroup.com/TWIO to generate that. Just go on to the S&P or the indices, equity indices part, and you too can choose. You can choose the E-mini, which I know a lot of you guys like to look at if you want to get the big stuff like our friend Sellopod and others down there on CME want us to talk about. You can get those there as well. Just click on the S&P 500 tab there, and you can get exactly what Nick is talking about here. And you're right, Nick, it has been a little bit, traditionally another reason we haven't talked about it, like Nick alluded to, is just because, we have a traditional investment skew, puts have a premium to the calls, and it's kind of what it is every week. I mean, that slope may change a bit, but at the end of the day, it's not the most harrowing of stories compared to, gold, which changes almost week to week, or even crude to a degree, and other things like that. Crude had that big inflection back in November where we saw the calls come to life. We haven't seen a big inversion like that in the S&P, and if we did, something crazy would be happening, and we certainly would be talking about it. But that said, maybe we should pepper more in. That said, Mr. Nick, have you found your details from the QuikSkew here?
Yeah, I mean, I think it's pretty obvious looking at QuikSkew. I'm looking at the week 3 contract that expires in 3 weeks. We're seeing that the put vol is coming in terms of richness to the at the money, and the call vol is getting bid. So this is kind of a shape of the curve that we haven't. We always talk about describing the curve, a smile or a slash from top left to bottom right. That's how the put skew usually is in the S&Ps. But what we're seeing here is the 25 delta call is almost flat with the at the money, and we typically aren't seeing that. So there's probably still people out there who are biased toward the put, but we're not seeing quite the spread on the range as we used to. In fact, let's use an example. We saw just on this date here on 123. So we're talking about Monday. We saw the calls were about 20%. Now that's not 20 vol, that's 20%. So about 20% cheap to the at the money. And as of last night, we had them about 10% cheap. So excuse me, you're talking about a significant jump in the premium, and for this week you could see that on a QuikSkew report. And we also saw the same thing, but in the opposite direction for the puts. We saw how the puts were roughly about 50% more expensive than the at the money, and then so if the at the money's 20, the puts 30, and now we saw that come in all the way to a 36%. So we're going to have to pay more attention, not only in the big contract, but we also saw that in the E-mini. Now keep in mind, the big contract, it's 5 times as big as the mini contract. There is 600,000 open interest there, and there's almost 4.5 million open interest in the mini. So, if you do that from a contract size standpoint, they're relatively close in terms of the OI. The mini has a little bit on it from a notional standpoint, but the fact that you're seeing that sort of sentiment in both places, which makes sense because there's an arb there if it's not. But I guess we're going to have to pay more attention, because if we get to the point where we're seeing a smile in the S&Ps, I don't think anybody has seen that in a long time, and we're going to have to go back and take a look and see when's the last time we actually saw something like that.
Wow, that would be a polar shift, maybe a smile in the S&P. It's been some time. I think a lot of the old school volatility heads say that the crash of '87 pretty much wiped away the smile. Because if you're not a volatility head listener, that's when people used to just pretty much put this. If there was a skew, it didn't really exist pre-1987, but if there was a curve there, it was all smile all the time. And we learned post '87 it doesn't really work. Hence the investment skew we've had ever since. But yeah, that'd be interesting, Nick, if we could get a smile going again. That would certainly be something worth talking about. Great question, Sellopod. We'll make sure to work more S&P big and mini into the show going forward. Next up, we got a question. Dan, this one's perfect for you, sitting over there on the CME hot seat. We get some variation on this question. It seems like a couple of times a week, but it's perfect timing with you on the show to talk about it again. This comes from Angelo, this particular permutation, but you can take your pick on it. People have sent this in. He says, I day trade futures. What's your thought on trading options intraday? This is kind of some variation on the theme we get, Dan, of, futures and stock, kind of the Delta One products are perceived to be more suitable for intraday trading. Options a little bit, at least traditionally, have been a little bit longer term, monthly. We'll get into the short duration in a bit, but you guys are all about the short duration options trading. So what do you have to say here for our friend Angelo?
Well, yeah, and actually, Mark, you really kind of nailed it. A lot of times people look at the more traditional equity options if they're doing the intraday type play, more so than the futures options. But and there's a few different ways to answer this question. One, are you already trading options? Because if not, take some time, study them. I think they're great contracts. I think they can be traded intraday. That's exactly how Nadex was designed. All of our contracts are very short term, basically options on futures type contracts. So depending on what you're trading, what type of time frame, they most certainly can be, and in a lot of cases they're complementary. If you're already day trading your futures contract, options have a lot of usability. They're not just a directional play. They can be very much non-directional. They can be used as a hedge, whether you're talking about something like a spread, an option spread, such a short term on Nadex, or even something to get into a position. I think sometimes when people day trade, they might, if they're just trading the underlying market, they might leave some money on the table. If you're day trading futures, I'm going to guess you've been stopped out once or twice in your life. Sometimes, depending on what the volatility is, what the cost of that option is, and what the required move is, again, depends on your market. All markets move a little bit differently. But at the end of the day, you've got to just consider what is your cost. Often options are great because you can actually put up less risk to initiate that position. If it runs in your favor, you can roll out of that option and then get into the underlying market and then just manage the trade from there. So there's a lot of different ways to approach this. I guess that was a long answer to say, yeah, I'm all for trading options intraday.
I'm going to make it even longer for you, Dan. But yeah, whenever I get this question these days, I kind of say to people, you have perfect timing to ask this question. You're kind of living in the renaissance here of short duration contracts. If we had been asked this question 2, 3, 5 years ago, I would have said, yeah, I think your synopsis is pretty much right. The Delta One stuff, the futures and the stocks is better to capture tick by tick stuff in the intraday. Options were still primarily monthly and beyond. It wasn't as useful. Now, in these last couple of years, the one thing we've talked about on almost every program on this network, including LSFO, including all of our volatility views and option block and everything, has kind of been just the explosion of interest in and products on the short part of the curve, the short duration stuff. So weeklies across the board. I mean, CME is adding weeklies pretty much every time you look over there. They have, they used to be only the one weekly, which was, of course, expiring on the Fridays. Now everyone's adding Wednesdays, and Mondays are in the talk. So it doesn't take a genius to realize sometime down the road, we're going to have effectively a weekly expiring every day, which effectively means you have not have dailies. So that's going to be really interesting. So I'd say, Angelo, if you're looking to day trade options, the short end of the curve, the really, really weeklies, and in these point, if you trade a weekly intra-week, it's kind of like a daily anyway. So you have a lot more. They're very, not to get too detailed, but they're very gamma sensitive. So they'll respond very quickly to swings in the underlying, which is exactly what you're looking for. So I think in terms of day trading options, at least from a product suitability standpoint, we've never seen a better time than this to really get in and trade these things intraday, scalp some gamma, do whatever you want to do with them. And they're far more suitable than it was a few years ago. We had to bite off, the least you could bite off was a whole month's worth of premium to probably trade maybe one day or maybe one event. And no one really wanted to do that. So the weeklies are kind of where the action is. Nick, do you agree, or are you going to take the complete opposite point and we're going to have a frenzied debate?
No, I would tend to agree. I just wanted to reiterate the fact that, like you mentioned it, so I'm being redundant, but I think it's important to mention it. And it's not just in the S&Ps with the Wednesdays and the Fridays. It's the other contracts as well. The gold has the weeklies, the crude has the weeklies, and the treasuries have the weeklies. So there's a lot of opportunity out there. The best opportunity probably being, and there's even daily contracts in all of the energy. There's a daily WTI, there's a daily nat gas. So those are a little less liquid, but the weeklies in the S&Ps and in the treasuries, you can trade those. I like to think, when I describe them, I like to think of them as almost trading like cheaper cheaper version of futures because, like you mentioned, the gamma is going to change the delta very significantly as you get towards expiration. So the reality is a 1 point move in the underlying is almost going to be a 1 point move in the value of that option price. So you're really getting a nicer, more modest margin-based trade that acts just like a future. And the fact that you got an expiration every couple days, and you can really play not only the short-term expiration, but the particular events that are going on in the market. The weeklies, and Mark, you and I always talk about how the gold and the crude, they need to get a kick in the pants from a weekly volume and open interest standpoint. I think you're going to start to see that as people become more aware. And as we start to see tighter markets, which we are seeing on the WTI and the gold in the Globex market, so yeah, I think I would like in the back my old sort of options trader personality would say, if you're sitting at home, you shouldn't day trade options. But we didn't have the and we were in the pit and we had the ability to scalp. But I mean, this one is where you're really taking a speculative position play, and you're just looking for a premium increase on not that much of a move, which is basically like having a cheaper version of a future. So I absolutely think it's a possibility to do right now. And the other thing is, and from a longer term option trading standpoint, you can, I don't necessarily know you'd be scalping in the same strike, but you may have an opportunity based on the move of the underlying where you can put on a trade because you have a certain opinion about something, and then if it happens to go your way, you can spread it off with another option, so you can lessen your margin, but also be able to get in one level in a strike that's maybe a little bit better from a vol standpoint, and then cover it with a little bit higher vol standpoint, and then play that spread as well. So plenty of opportunities out there, no matter what you're trying to do.
That's a good point, Nick. Actually, it's something to get what you're talking about just earlier there, Dan, as well, about kind of the volume in your crude oil contracts and the binaries there, because that's something we talked about here on the show a lot. WTI obviously lights it up, except for the weeklies, and it's kind of been a bit of a head scratcher as to why that particular portion of the curve, even though the front month is extremely active, the weeklies are not. And maybe as your crude continues to grow and generate volume, it might be interesting to see if that spills over and accretes back into the weeklies, because it's a natural hedge, it's a natural arb between those kind of near-term binaries you're talking about and the weeklies in WTI. So who knows? Maybe that's a bit of a growth trajectory as your stuff continues to take off. I think that would probably eventually accrete into the weeklies. Would you agree?
I would definitely tend to agree. I think one of the things we offer are really the simplified options, which give people everything's built into the price. So as you're learning all of the Greeks, and this really applies to the newer traders, but with the short term, with the event of the short term, when we were talking 4 or 5 years ago, there was just no opportunity. As you mentioned, you've got way too much premium built in. In one day, you're not going to see the move that's required to even get you anything. But now with the short-term contracts, they're so much more sensitive. And so I do think we'll see that spill over. And I'm really hopeful, because I think options are one of the best tools ever made for every level of trader to take advantage of these markets and the opportunities in there. And as Nick was saying, you can trade the underlying, but in a lot of cases, if you've got basically 1 day option, you've got a vehicle that's almost the same, only probably offers quite a few benefits that you can't get just straight from the straight futures contract. So I do look for that to spill over. I do look for just general growth in these products.
All right, Mr. Nick. I'll leave it up to you, Mr. Nick. Do you want to do that last one? We're kind of coming up against it, or should we just hop on into the wrap-ups here? What do you want to do, sir?
I think we hold off on that because that's more SPX oriented than S&P. So I think that we covered a good amount on the S&P index, and we covered it from the CME standpoint.
I was feeling the same way as well. We kind of hit on a lot of S&P. We can't go over. Just because we get questions about it doesn't mean we can go over S&P. But good questions nonetheless. Keep those questions coming. We love to hear from you guys. All right. That music means we've come to the end of another epic journey through the world of futures options. We started off talking, of course, a WTI Brent spread and the ongoing evolution, that battle, Trump versus those guys. He was bidding that spread up. Now he's crushing it, and now a little bit in between. So I think that's going to continue to be a hot product for the near term in the future here. Also talking about the big mothership WTI, still lighting it up, getting into some of the binaries in WTI and, of course, in gold. Gold also very active, and the volatility out there still a bit of a head scratcher as to why people aren't bidding it up. The product has been moving, people are not buying vol. Kind of interesting. Got into a few of your questions as well, including, of course, you want some more S&P love. We hear you. We'll reflect it on the show. And, of course, your thoughts about trading. Pretty much we get this question every week. Day trading options, intraday. So yet another one here on Twifo. But we love you guys. Hit us up if you haven't done so already. We got a lot more here to get to. Didn't have time for it today. Maybe we'll get to them on next week's show. But that said, Dan, we'll start with you over there in the CME hot seat. Before we go, give us a bit of an overview again. If people are interested in a lot of these short-term contracts, maybe trading them against their existing futures options type positions, where should they go? What should they do?
They should hop on over to nadex.com, nadex.com. We do offer a lifetime demo account. Well, technically it expires in 2048. But if you need an extension, then I'm sure we'll be happy.
That's not enough for me, sir. I need more.
Whoever's there then, I'm sure we'll be happy to extend it for you at that time. But no, I mean, it's free. It's a great way to check it out. You can run it concurrent with your existing strategies if you're trading futures. See if it's something right for you. No pressure. We are an exchange. If you have questions, we've got great customer service and a ton of education on the website.
Yeah, and I definitely encourage that use case, too, is if you are listening to this show, you're probably interested in futures options. So using those binaries, I think you probably agree, Dan, those binaries as kind of a kicker or a hedge to your existing futures options positions is an easy starting point for people because they already have their kind of heads wrapped around it. Rather than just diving pure into the binaries, it may be a little bit more of a learning curve for them. But if you use them in conjunction with the product you already know and understand, it may be a little bit easier to wrap your head around.
Yeah, absolutely. And one thing I'd hit on with that is with a binary option, you're not trading a different market. All of your analysis, everything you're doing, it's all driven by the underlying market. It's just a different way to express an opinion about the same market. So it's not like you have to relearn everything. You need to learn the contract and how they're structured, but you're not learning the whole new market. And I think that's an important point.
Yeah, a little bit easier on the learning curve from that perspective as well. And Mr. Nick, as always, you guys over there at QuikStrike always working on cool iterations and cool new tools, open instance profile, updates to QuikSkew, et cetera, and so on and so forth. What do you guys have coming down the pike for us this week?
Let's see, this week. So I think the big news that occurred Sunday to Monday was the first step in a really tight integration with CME Direct and QuikStrike. So if you're a CME Direct user out there, you can now open an embedded window that will load the QuikStrike analytics right into your platform, and then you can tie that window to the clicks in the actual bid-ask screens and the strategy screens and stuff like that. So if a block comes through or a trade or an RFQ comes through, you can click on that trade and it'll build the trade for you in that embedded window where you could look at the Greeks, look at the break-evens, you could play with it, move the future of the vol and the days to expiration, and also get a bunch of other information, history for that particular trade as well. So that's the big news this week is the more close to complete and tightly integrated version of QuikStrike with the CME Direct. And then as far as the other stuff coming out, this is going to be a big quarter for some report releases that will be taking place out on the CME Group website. As you mentioned, we put this new summary view within the open interest profile tool, which will let you go and look at a market in the aggregate from an OI volume, all that kind of thing, and see how the change has gone. So it'll be a good gauge as to what's been happening in that market over from day to day, or even over the course of a period of time. So just keep an eye out. We'll keep mentioning it. But if you need to go and see anything, all the free tools are available. CMEgroup.com/QuikStrike. Drop the C in Quick, QuikStrike. And there's also the free version of QuikStrike called QuikStrike Essentials out there, which is gives you a little bit more functionality than you might see for free on the website. So we'll keep you posted.
There you go. You heard the man. CMEgroup.com/QuikStrike. Leave out the C, or if you want to follow along listening to the show after the fact, CMEgroup.com/Twio will get you that report that we use throughout the show as well. So you get to see nice live data. You can see what the heck Nick and I and our guests are talking about every week. And on behalf of Nick and Dan, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing. Of course, all of you can join us live every Friday at 1:30. We love you guys, too. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuikStrike, options pricing and analysis software. QuikStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuikStrike has you covered. With market data reports ranging from open interest to the term structure of volatility, QuikStrike is the perfect addition to your trading toolkit. Learn more about QuikStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuikStrike1. That's QuikStrike1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.